What's up everyone, my name is Fred Tam and welcome back to another episode in my series for pre-construction condos where we talk about every single aspect of the process. In this episode, we're going to be looking at how a pre-construction condo can be a guaranteed investment to building your financial wealth. Welcome back everyone. Today we're going to be looking at how a pre-construction condo can be a guaranteed investment. And for anyone watching this video who has gone through the process of buying a pre-construction condo, the one thing you might be thinking is how you wish you bought more than just one unit. What I would caution on that, however, is when it comes to making any investment decisions, always do your due diligence. What this could look like with pre-construction condos is researching the developer, the builder, and seeing what their past project history is like and under what timelines were they able to manage their projects. One other thing that we'll be looking at today is how a pre-construction condo can be the first step at building your real estate portfolio. If the idea of having a real estate portfolio is something that had never crossed your mind, believe me when I tell you that the possibility is there. It requires a lot of discipline, time, and patience, but it's worth it in the end, and today we're going to be looking at how. So keep watching and stay to the very end because I'll be showing you how you can generate passive income through your pre-construction condo. Also, please hit the subscribe button and the notification bell because doing these two small things will let other YouTube viewers discover my channel and the content that I put up for you guys. Alright, now let's get into it. So when you purchase a pre-construction condo, you invest less of your money early on while maximizing the potential of your return on investment. One of the first ways a real estate investor will approach a property is by analyzing the potential for cash flow. So cash flow is the amount of money coming in and out of your property investment. With a condo investment, it's going to be your rental income less your operating expenses as a rental property. Now let's say several years ago you purchased a pre-construction condo for $500,000 and put 20% down. Since then, the rents have gone up and so have condo prices. You decide to rent it out, and with the help of a realtor who negotiates the rent with the tenant is now going to pay you $2,500 per month. In this example, we're going to be using some numbers that are relevant to today's market. So now your monthly mortgage payment based on a rate of 2.29% and an amortization period of 25 years is going to be $1,750 per month. Other expenses will include property taxes, maintenance fees, and also property insurance, which in today's market can add up to around $700 a month. Because this is a condo, there are no other operating expenses and you've decided to manage the property on your own. This means collecting rent, maintaining regular communication with the tenant, and also accommodating any of their requests as their landlord. Now your monthly cash flow is calculated by taking the monthly income and subtracting the monthly expenses, and you end up with a positive monthly cash flow of $50 per month or $600 per year. And this is what's known as positive cash flow because your income is greater than your combined expenses. So now that you're cash flow positive, your investment property is also a new source of income for you. On the flip side, with a negative cash flow property, that's when your expenses are greater than your income. You'll be paying out of your own pocket to maintain the investment. And out of the two scenarios, you want to try your very best to have a positive cash flow property. If you consider the scenario that we just looked at, there's also the added benefit that your tenant is paying down your loan, specifically the principal portion of your mortgage. This brings us to the second way to win with a pre-construction condo, principal paydown. Part of it goes to the bank as interest for the loan, and the other part goes towards the principal. Now when the principal is paid down, it increases your equity in the property. So now you've got your tenant who is helping to build your net worth and the equity in your property with every mortgage payment that is made. Let's go back to our example of the $500,000 condo with 20% down and fast forward 5 years later. Over 5 years of mortgage payments, the interest portion goes down while the principal portion goes up by nature of the way amortization schedules work. About $105,000 is paid off in your mortgage, $63,000 is paid off in your principal, and the bank gets their $42,000 in interest. But in those 5 years, $63,000 works out to be about 12.6% paid off on your mortgage. Now, this doesn't include any fluctuations of value increases over those 5 years. This brings us to our third way a pre-construction condo can be a guaranteed investment for you, which is appreciation. Now in the same scenario, you invested 20% of the purchase price as a down payment through a scheduled deposit structure and got the remaining 80% as a mortgage from the bank, but the property will appreciate at 100% of its value. So here's where I want to shift your mindset a little bit, because if you consider what we just talked about, then the bank is essentially financing your growing equity. This is one of the reasons why real estate investors like to leverage other people's money. As soon as you make a pre-construction condo purchase, your investment has the potential to increase in value almost immediately. This is because the value of the land that it sits on grows over time, even before construction actually begins. We're limited to how much land is available on this planet, and we can't just make more of it, so as land becomes more scarce, its value goes up. Check out this example. This home was built in 1924 and sits on a 25-foot lot in Toronto. My guess is that replicating this house would cost no more than $200,000. Now get this, it was recently sold for just under $1.4 million. If you're ever in the market for a home and you see one like that sell for $1.4 million and you don't know why, or even if you're just curious and you go online to look at sold prices, here's where I really want to change the way you think. In many cases, the land is worth much more than the improvements made to the land, which in this case is the structure, and together they create the property value. And because land is scarce, it has become one of the major economic contributors to rising home prices. While population growth continues to rise every year while outpacing housing supply, the demand for housing increases while also increasing the value of real estate. This is one of the reasons why cities like Toronto are now growing vertically rather than horizontally. More high-rises are developed to increase housing supply, but it's still not enough to keep up with the population growth that we're experiencing every single year. So now which one would you say is more important to you, cash flow or appreciation? Let me know in the comments below, and also hit that like button if you're enjoying this video. Another point to consider is that residential rents typically increase every year. A residential landlord can increase their tenants' rent once a year based on a rent guideline set by the Ontario Consumer Price Index. This index measures inflation and economic conditions over a year. So now with inflation, you'll also be realizing an increasing income every single year. Now up to this point, are you starting to see how a pre-construction condo can really be a guaranteed investment and potentially kick off a real estate portfolio for you? Now it still gets better than this because you can potentially be eligible for certain tax benefits. Now, when it comes to any tax information, including from a random guy on YouTube, always seek the service and advice from a professional accountant before acting on that information, including what we're going to be looking at next. As a residential landlord, you would be eligible to deduct certain expenses from your taxes, including the property taxes, property maintenance, insurance, and even your mortgage interest. This is because those expenses are directly related to operating your property as a rental. Deducting these expenses from your taxes for the year also means more money back in your pockets. Now, this is the first tax benefit that applies when you still own the property. Now let's jump to another scenario where you decide to move on from the investment and you decide to sell the property. This also means there will be tax implications on the investment you just sold. Only 50% of all realized capital gains in Canada is taxable. Let's go back one last time to our $500,000 condo unit. During those 5 years that you held the property, it appreciated in value, and you also ended up selling it for a market price of $700,000. Excluding other closing costs, the difference between the two numbers is your realized capital gain. Capital gains tax is only on 50% of the realized amount, which in this case is about $181,000 that you would declare your income taxes on, rather than the full $363,000. So that's the second tax benefit that applies when you decide to sell. Now let's recap on the 5 ways a pre-construction condo can be a guaranteed investment for you. The first one is cash flow. When you've got positive cash flow when you're renting it out, your condo unit also now becomes a new source of income for you. Leveraging your property as a tool to create income is one of the ways you can win with a pre-construction condo. The second benefit was principal paydown. Each time you receive a rent check from your tenant to pay your mortgage payments, they're helping you not only pay down the interest but also the principal balance while increasing your equity and net worth. The third way to win was appreciation. You leverage the bank's money for your investment as it grows in value over time. Real estate appreciation is unlike the appreciation of other investments. If you put down 20% on a property, you not only get a return on the 20% that you invested, but also the remaining 80% due to appreciation. You realize 100% of the reappraised value. We also talked about annual rent increases. Every year as a residential landlord, you are able to increase the tenant's rent based on a rent guideline. We looked at an example where being a residential landlord for 5 years with the same property, your positive cash flow can be increased by about 30%. The fifth benefit that we looked at were the tax advantages when you hold the property as a residential landlord, but also when you sell the property. Every tax year you can deduct certain expenses. You also claim only half of the realized capital gain if you decide to sell one day. So that's it for this episode. If you learned something today and you like this video, hit that subscribe button and also hit that notification bell, because if you don't, then YouTube doesn't let you know when our new videos are out and you could really miss out on some cool educational real estate content. I hope you enjoyed this episode. Thanks for watching, and I'll see you guys next time.